Hi, I'm Kep Kepner CPA here in Dallas. Some of us have very complex tax issues. Others have very minor tax issues, other than you got to come up with the cash to pay the tax you owe. But let me describe to you a particular circumstance. As a CPA, I go to a monthly meeting that has about 100 CPAs, and any of us can ask questions and get the input from this large group of CPAs about how to handle a technical issue. So let me talk to you about one circumstance that came up. It's really kind of interesting. There's a company, and what they do is they buy television sets, install them in car washes, and maintain those. So people that come into the car wash can watch TV. The owner of the car wash doesn't have to do anything. They get a little bit of money off that. But the bottom line is they've got this thing set up so there's entertainment for their customers. So this client, this business, had a wonderful year last year. They made $4,800 and they had a loss of $148,000 because they were buying these TVs and using contract labor to install them in a whole bunch of states. So the question came up, this entity is a partnership. Do they have to file a partnership return in all of these states in which they didn't make any money? Well, the term that comes up is the term Nexus. If you have Nexus, you are supposed to file tax returns in states in which you have Nexus. Now, every state has a little bit different rules, but in general, if you have people, a place, or things in that state, you probably have Nexus. People may mean a full-time employee, but it might also mean a sales rep who lives in Dallas and travels to Michigan to sell to customers. That may give you Nexus in Michigan, and you may need to file Michigan taxes. So you might have people, you might have place. Well, you have an office. So let's say you set up an office. Well, you've got Nexus in that state. The third thing is things. Well, things might be television sets that you own and are set up in car washes in that state, or others might be sales. Simply you have sales in that state. So you have Nexus, and you have to file tax returns in those states. Many companies that are small don't file in those states. They just wait for it to get caught up. So there was an intricate technical question about should you file in a state when, let's say, it counted for 10% of this $148,000 loss. So maybe you could use that against profits in subsequent years if the business starts turning a profit. Well, it's an intricate question because it depends on the kind of entity. In this case, it was a partnership, so the losses were not attributed to the company, but they passed through to the owners. So typically, there's not a loss carry forward for an owner in a state unless there is a federal loss carry forward. And there may or may not have been a loss carry forward in this case. It depends upon the owners of that business. So there can be very intricate tax circumstances that need discussion and need research. So the questions in this case, did he have Nexus? Did he have a capital loss that he wanted to carry forward, or an operating loss, excuse me. If he had an operating loss carry forward, did it do any good for him to do that? So all of these questions would be solved by understanding that, discussing it, maybe deciding on a different form for the entity. So all of these things affect the taxes not only for the entity, but also for the owner. So if the owner is in Dallas and gets income in Georgia, let's say next year they make a profit on this business, then he's going to owe tax in Georgia for that business that he has Nexus in. So it's a complicated matter. As you grow, your tax consequences get greater, and you need to do some really good tax planning, and we can help you.